When I work through auto insurance, some tricky issues with auto insurance. We're doing it fairly generically, so every state will be a little different. So you'll just have to kind of research your own state. I showed you the Texas Department of Insurance. They had a document for homeowners. They have a similar document for auto. I didn't give it to you, but it's a similar type of just discussion of auto insurance and things to look out for. And you can get that off the TDI's website. But we'll start with Section A. Section A is a big part of auto because it's such a dangerous thing we do driving around. So liability coverage resulting from ownership, maintenance, or operation of an auto. It doesn't have to be your auto. So you do have liability coverage when you're driving someone else's car with some restrictions. You can't just get a car and not tell the insurer about it and drive it all the time. So, but the ownership, maintenance, or operation of an auto, all states have some type of requirement, and this stuff could be a little dated. So it's more of the concept. They want to make sure if you're driving around in a car that you have the ability to cover the losses you might cause. The limits by state vary, but it can be per accident, bodily injury, death. You know, they're going to have different limits depending on what's actually being covered. So, you know, you're talking about 20,000 per accident for bodily injury or death for 2 or more persons, 5,000 per accident for property damage. It doesn't sound like much. So these numbers may have been updated. I don't know what they are currently in Texas. But you have to buy at least that minimum. So you hope someone doesn't hit you that all they have is $5,000 worth of property damage, because that wouldn't fix many cars. But it does include covering your bodily injury. So there is a health insurance aspect to this. And we'll get a little bit into that when we talk about uninsured motorists. I don't really care if you know the different types. You can just quickly look through them. Sometimes it's at the time of the accident, you have to provide proof. You have to make sure, you know, that's kind of a little late. You have to provide proof at the time of the accident. Some states like Texas, you have to have auto insurance at all times. Some states say you have to have auto insurance, liability insurance, or you prove to the state you're financially responsible and you can self-insure, but you have to, I don't know what that kind of proof would be. All right, so the insured is the named insured, his or her spouse, or any family member who owns, maintains, or uses the auto or trailer. For friends, they have to be using your car for them to get some of your coverage. Any person using a covered auto, any organization legally responsible for the person using a covered auto, any person or organization legally responsible for actions of named insured. So it is possible to get other people covered through your policy, especially if they're using your car. The coverage is what you would expect: legal costs, any kind of interest expenses, those type of things, and of course the losses. And some of these numbers are probably increased with inflation over time. Sometimes the legal costs can be the biggest part of the bill, so you want to make sure you have that coverage. Exclusions, intentional injuries, it'd be kind of questionable, you know, what's intentional or not. Now, if you loan your car out to someone who you just know is a horrible driver, you get to the point where it's almost, you know, you should have known better. That can get tricky. I don't know how many of y'all loan your cars out. I noticed some UTSA students, it's like 4 or 5 of them got together and were sharing the same car. I don't know how they had their insurance set up to do that. That's kind of a dangerous thing. Damage to what you own, you can't be liable to yourself, but Part D should cover that. So you can't say, wow, I was really careless. I want my Part A to cover my property damage. If it's workers' comp related, workers' comp is always an exclusion on all types of property casualty insurance. If you're in a business of some kind, public or livery conveyance, auto business, you're engaged in the business of parking, repairing, selling, servicing, or storing vehicles. People using your car without permission, they can't rely on you to provide your liability to them. Unusual vehicles, fewer than 4 wheels. Obviously, you can get separate motorcycle. I don't think y'all drive motorcycles. You can get separate coverage for motorcycle insurance. I think I've even seen some Progressive commercials about that. Dune buggies, things that are not supposed to be on regular roads. So you got a car you use all the time and you haven't listed it, you can be in trouble there. Racing or speed contests, essentially breaking the law. Other provisions, out-of-state coverage, pretty important because every state has different rules about financial responsibility, and you don't want to drive from Texas to Oklahoma and suddenly you're violating the law. And so what out-of-state coverage says is, hey, when you leave Texas, go to Oklahoma, if their laws are more restrictive, then you're automatically have their laws covered. So you pick up free coverage while you're there. You can't buy 3 policies and it pays out 3 times, and whoever you hit gets this huge windfall. One policy will pay, the others will, or they make a pro rata, but yeah, you can't load up. So for non-owned autos, it kind of depends. There's an order, so that's the big thing. If you get kind of any insurance under your credit card or whatever, there's going to be a fight for who pays for what. We'll get into that a little more when we talk about uninsured motorists. All right, so there's part A. That's your liability. That's you're causing your fault. You cause damage to somebody else or to their property. You have to have it in the state of Texas. It's the only part you have to have in the state of Texas. There are some states that require other parts, but in Texas, you only have to have liability. So for me, when my car hits a certain age, I cancel all Part D, and I just kind of go, hope nothing happens. Usually if my car hits 10 years, if it's only worth $500, I'll just say, if I wreck it, I'll just go buy a new car. But I have to have Part A. That's going to be important. Now, Part B is the strange one. Part C is the one that gets more press, but Part B is medical payments. And essentially what it says is someone's in your car and you have an accident and they incur medical costs. This covers their medical costs. It's essentially medical insurance. Covers the insured's bodily injuries. It covers yours. It's not, yours or whoever's in the car. Bodily injury, funeral services from an accident caused by the insured. So you're the one that's driving. Covered while occupying or as pedestrian. So here's where you get some pedestrian coverage. People think that's important. Non-insured coverage only while occupying. So they have to be in your car to get the coverage. So this is the policy, part of the policy I don't have. So the question is, this is overwhelmingly health insurance. Do you need this if you have health insurance? And I argue you don't. And then the big, we'll see some of those debates. Then the big argument is, yeah, but what if you give some kids a ride? At your church, there's going to have some event. You take, 5 teenagers just do the event, and you have a wreck, and one of them gets injured, and they don't have health insurance. I say that's perfect. So now I can tell them, no, I cannot drive any young people anywhere because I don't have Part B. So it's like, to me, it's wonderful. So it completely kicks me out of being able to drive a bunch of kids around. So do you need this if you're worried about the limits and all these kind of things? My lawyer friend, he argues that, you need this, and he talks about how much you can lose. And my question to him is, well, if they need health insurance, and this is the only health insurance they have, they're going to make sure if they ever need to go to the hospital, it's because they're riding in someone's car. And that's the only time they need cover. That seems like a pretty limited health insurance policy. So if you need health insurance, you need health insurance. Buy health insurance. Unless you can, if you get some terrible disease, maybe they can throw you in a car and have a wreck or something, but it's going to be tough They cover everything. So it's a very, very limited coverage. So yeah, is it important? Yeah, it's important. Health insurance is important. Do you need this in addition to that? Now, this can get really, really tricky when people don't have this coverage because the health insurer, the first thing the health insurer is going to ask you is, were you in a car? Because they want to know if you have Part B, because they don't want to cover you. But if you have health insurance, then the two are going to debate, and what will happen is your Part B will be dominant and your health insurance will be secondary. So your health insurers get out of the. So the strangest story I heard, a good friend of mine, she was hit in a really terrible auto accident. They actually had this lifter on a helicopter out. It was so horrible. And then after the fact, she couldn't find anybody to pay her bills because her health insurer and his auto insurer were fighting with each other as who's going to pay it. I told her, just call your health insurer and have them pay it, and then they can get reimbursed from his insurer, But it's frustrating for her because she had these massive bills. I mean, no one that's, in traction wants to be worrying about insurance. And I have health insurance. Why do I have to go through all this mess? And yet there's this big fight between the two firms. So to me, it's almost better if you don't have it, then you don't have to worry about that big debate. You just call your health insurance company. But that is what they're going to ask you. Were you in a car? Do you have Part D, Part B? Supposedly with health insurance, but I don't think this is true. Supposedly health insurance does not do a coordination of benefits, which means if you have dual coverage, you can get paid twice. But my guess is most health insurance policies actually do have that in their policy. They actually put that in there because they don't want you to have any kind of an incentive. So I don't have Part B. We'll talk a little bit more about it. Did y'all check to see if y'all had Part B yet? Do y'all know? Anybody know if they have Part B? So if you don't know if you have it, guess what? You probably have it. All right. Because you would have to explicitly turn it down. But go look. It's not cheap. It's pretty costly. You could buy quite a bit of life insurance if you turn this down. That's my argument with my lawyer friend. The two of them together, Part B and Part C. But it is essentially health insurance. Part C is the more controversial one, uninsured motorist coverage. So you say, well, that shouldn't be possible because the state of Texas requires everybody to have insurance. So how could someone hit me who doesn't have Part A? Well, obviously people drive without insurance all the time. And in fact, there's studies that show they drive without insurance more often in states that require insurance than in states that don't require insurance. So it's kind of questionable if they actually work. So states with these laws have actually seen an increase in uninsured motorists. Uninsured motorists, about 15% of the drivers. In states with compulsory laws is about 20%, but that could be because they had a bigger problem, which is the reason they put it in place. So there's checkpoints, but you just make sure you have it at those checkpoints. I don't know what the impact of like the military. I know military bases were checking insurance coverage just to get on base. Obviously, we get stopped for any kind of infraction. They're going to ask for your insurance proof. When I get my car inspected, they ask for the insurance every time. So, it's going to be tough to get around, but people can buy it and then let it elapse pretty quickly. So yeah, you got a decent probability of getting hit by uninsured motorists. It's not huge, but first of all, you're not going to have that many accidents. So maybe you have one accident every 10 years or so. I've had one accident in the last 50 years. So you're not going to have hopefully y'all aren't having accidents every year, every 6 months or something. And then if it does happen, you got a 15-20% chance they're uninsured. And so what happens in that case? So one thing to make sure you know is Part D is in place. So the fact that an uninsured motorist hits you doesn't mean your car won't be replaced. Your car will be replaced by Part D. You have to pay the deductible and all that, but you have property damage coverage. So don't think like, wow, uninsured hit me, my $40,000 car got totaled and I didn't have Part C. What do? Well, your insurance company will reimburse you for that. So we'll have to ask, what is this actually covering? If it's not covering damage to your car, what is it covering? All right. So who is an uninsured motorist? They don't have Part A and they're at fault. It's important that they're at fault because if you're at fault, this is going to help you. It's going to go to your Part A. Has no bodily injury insurance, or it can be a hit and run driver. A good friend of mine, she was a victim of a hit and run, and she had this insurance, and she was glad she did. I'll talk about the coverage that she got. Or the insurance company becomes insolvent, or for somehow they had insurance, but it was below the what the state required. That shouldn't be possible. Underinsured is someone who has the insurance, but it's not adequate to cover your losses. All right, so we have uninsured and underinsured. You can get funds even before the courts decided that they were at fault. Most states require, that's why I think most of you have it if you don't know, most states require you have to specifically turn it down. And so most of the time they just ask if you want it. Most people, yeah, of course, that's what I want. And some states do require it. I convinced a friend of mine to get rid of B and C, and then he moved to Colorado and they require it. He's like, oh, well, you made this really strong case and I don't have that choice. What does it cover? So this is really important. What does it cover? Covers bodily injury, medical costs, lost wages. So bodily injury. How do you get bodily injuries covered? How do you get medical costs covered? So there's your health insurance. The same thing again. If you have health insurance, what about lost wages? How do you get lost wages covered? Your employer provides it. Either it's time paid off, paid time off, or long-term disability. So most of you will have health insurance and disability through your employer that covers those two things. I mean, bodily injury, medical costs. So if you don't have this, then people say, well, then you better get this coverage. But I say, well, if you're worried about lost wages, again, why are you only worried about that if you're in a car accident? Why aren't you worried about it in other situations? Are there other reasons you could have lost wages? Could you get really sick? Or, so I don't buy the argument that, yeah, but your employer doesn't provide it. Yeah, if you need the coverage, buy the coverage. Don't buy it for just a 1 in a million chance you have a car accident with someone who isn't insured. It is for compensatory damages. This is going to be an extremely important one, but it's not punitive. So this insurance is not going to say, hey, we need to sue this guy for $10 million because he was just so blatantly negligent. But it does cover compensatory. And this is the big one. This is where you got to decide. The one big thing that it covers is pain and suffering. And we'll talk about that, why I don't think pain and suffering is important. Property coverage, really not important because you still have property coverage under Part D, so you're there. So there are some exceptions. I'm going to ignore these exceptions. Essentially, what they're saying is, hey, if you only got $150,000 of coverage, don't expect this person, get $250 from this person. What they're gonna, you're gonna have to live with your own decisions on what liability you buy. Some states said, we'll know how we'll fix this. Let's eliminate the whole need part C, and let's go to no fault insurance. And this was really, really interesting. I really think it was McGovern, Bill Graham. I really think it was those two. Let's see if it'll come up. I thought it was those two, but I may have Phil Graham. I know it for sure it was McGovern. So McGovern is far left, Graham was far right, and these two came together for a federal no-fault law. Probably the only time in history those two ever agreed on anything. So what is no fault? So what no fault says is when you have one of these accidents, your insurance pays all your losses. Whether you're at fault or they're at fault, it doesn't matter. So you have an accident, the insurance company says, we don't care who's at fault, all we care is our insured. So you have an accident, your car is damaged, it was the other driver's fault, your insurance company says, we don't care. You're our insurer, we're paying for you. What happens if the other person doesn't have any insurance? They're out of luck. They should have an insurance. Even though you're liable and you made a mistake, they say, hey, you're supposed to have your own insurance. So that's what no fault says. Essentially saying no one's at fault. You just buy insurance. Anything happens to you, your insurance company pays for it, no matter who's responsible. Why did it do that? Mainly, this is an anti-trial lawyer law. Essentially, what they're arguing is when we do have these accidents, the only one that wins are the lawyers. They get all the money, and the actual injured person doesn't get much, especially a really injured person, because a really injured person is going to want a lot of money, and that's when the lawyer is going to come in and sue. If it's a small amount, they tend to get overpaid because no one cares. But the large amounts, that's when people fight. And so it's the people that are the most injured that get the least, and the lawyers get the most money. The recovery process can be very, very slow.
Do you see more insurance companies doing the no-fault auto insurance, or do they?
Well, it's the states have to mandate it. You can't have some do it and not others. So the entire state has to be no fault. And that's why they have this federal no fault things, everybody has to do it. So yeah, you can't have it where, you can choose whether you do no fault or not, because then if someone who's not no fault and it's your fault, then you got to pay for theirs. So yeah, it's got to be the whole state has to do it.
So in cases that they don't do the no fault, do most of the time just the uninsured companies they're not having insurance.
We can try to sue them. They probably don't have insurance because they probably can't have no wealth.
Yeah.
And if it's a hit and run, you don't even know who they are. So, yeah. So in that case, if you don't have Part C, then your damage to your car is covered under your Part D. But any bodily injury, lost wages, you're going to have to make sure you had insurance. If you have health insurance, it covers you. You have a disability, so you're still covered, even though they're probably going to ask if you were hurt in a car accident. But if you say, yeah, I was, but I don't have Part C, then they have to pay for your bills. So it really comes down to, what does this cover that you don't already have insurance for? Remember what I said about insurance? It's a losing proposition. You don't want to duplicate coverages, because it's just not the way to go. So, and when the lawyers get involved, it can take a long time. I've been involved in a couple of cases, and the lawyers are not in any hurry. They're moving really slowly. I dealt with this one lady. It was kind of awkward. She was in a car accident, and she was suing her insurance company, and she said, go with me to the lawyer. I said, well, I'm an officer at USAA. So if you're suing USAA, no, I can't go with you. She says, oh no, it's not USAA. So we show up at the lawyers, and she's suing USAA. I was like, sorry, I really can't help you here. There's no way I'm going to help you sue my own company. So very, very awkward. But what frustrated me was she was in really bad health. I mean, she was not expected to live much more than a year, and they were dragging their feet, and she was desperately needing the money just to pay her basic bills. And so the only thing I said to the lawyers is, there ever a time where time is of the essence with you guys? Because this thing's taking months. And I didn't say she's about to die because she's sitting there, but it's like, she really needs the money right now. But yeah, they were not in any big hurry whatsoever. Small claims overpaid, big claims being sued. So essentially, no fault is really more than anything tort reform. It's trying to say, all that money going to lawyers, let's just eliminate all that and let's give it all to the injured parties. So that's the goal of no fault, is more equitable distribution. The problem with no fault, there are a few states that have no fault. The problem is they have what they call a limit. And they'll say, hey, if it goes above this limit, no fault no longer applies. So it only applies for losses below, say, 5,000. Over 5,000, that's so big you can now go sue. Well, what they discovered is, if you have a loss of 4,800, you now have an incentive to exaggerate it over 5,000, so you can now go sue the other party. So it was actually increasing claims. So if you want a true no fault, you'd have to not have those limits. There were a few other exceptions, and the federal one saying, hey, if the other party was intoxicated or under influence of something, then it doesn't apply. You can sue them. You know, there's a few exceptions like that, but for most states, it really was not affected, mainly because the threshold was just way too low, and so people were just getting around it anyway. So wasn't that it didn't go anywhere. It was actually pretty heavily debated by Congress, which created some issues because states regulate insurance, not Congress, and so Congress was going to pass this law that was going to affect all states. So it was pretty interesting. Didn't quite work. We'll come back. We're going to come back to these two here in a second. Just real quickly, residual markets, much bigger deal with auto insurance than homeowners insurance, but there's many states where people are just not insurable. And so maybe the reason we have these uninsured motorists is they just can't afford to buy auto insurance. So let's force the insurance company to provide them insurance at a reduced rate. So essentially you go to State Farm, you apply for a policy, it's too expensive. You then go to the state and say, hey, I tried State Farm, I can't afford it. The state provides you a subsidized rate, and then they go to State Farm and give you your policy to them. And State Farm, USAA farmers, they lose money on this in the millions. At USAA, I think it was $40–50 million they were losing. It's a big number. Insuring people that probably shouldn't be driving, a lot of them probably can't get insurance because they're just really bad drivers and they have a bad record. So you have residual markets, assigned risk plans, and reinsurance facilities, and joint underwriting associations. So essentially, there's just different ways that states can take all these people that aren't insured and just force them back onto the insurance industries. In some states, I forget which, if it's Michigan, maybe there's some states where this became almost the majority of the insureds in the state. So it got pretty ridiculous. We don't even know the details on how they work. All right, so Part D, real quickly, is everything else. It's comprehensive and collision. Collision is your car impacts some other object. Doesn't have to be another car, but impacts some object. Comprehension is essentially everything else. So it covers non-owned vehicles. So that's where your rental car comes in. So again, you should check on that. It doesn't cover wear and tear, so maintenance, those type of things you're supposed to take care of. Now, I do know, and I've never tried one of these policies before, there are these maintenance policies you can buy. I don't think you buy those from insurance companies, though. You buy them from auto dealers, don't you, or from mechanics. I don't know how good those are. It's like everything else, you're going to pay more than you expect to pay because they've got to make money on them. But that's not what the insurance company does. The insurance is not a maintenance policy. The due and confined to can be a little tricky. If you got some obvious damage to your car and then you're in a major wreck, essentially the insurance company's fixing something they shouldn't have had to fix because it was already damaged. But how do you know? Kind of almost the storm surge thing. If you got a car loan, they're going to pay the bank first before they pay you. Equipment in the car is not covered unless it's permanently part of the car. So that's where your homeowners is going to take care of that. So, so you're covered if you have homeowners, but if you assume, don't assume you have auto insurance and you have $1,000 pair of golf clubs in the car that you're covered. If you don't have renter's insurance or homeowners, you're not covered, and that gets stolen. You're out of luck. When my bike got stolen, auto insurance paid me $0 and the homeowners paid me a couple $1,000 because my deductible was so high. All I had was a broken window, so I couldn't fix that. But they paid for the bike pretty amazingly. Right, so you don't have to have Part D, and if you have an older car, you don't need to get Part D, even if you carry expensive stuff in the car, because your homeowners will cover that. Have any of y'all done the rate online on Part D? That's where your deductible comes in. I mean, I encourage you to try it. Although, if you try it and increase your deductible and have an accident, don't come complaining to me. All right, so what is your coverage? It's actual cash value. Remember, with the house, it was replacement costs. With the car, it's actual cash value, and y'all probably all know Kelly Blue Book. Now, Kelly Blue Book has gotten pretty interesting because of what happened in 2020 and 2021 with used car prices. I don't know if Kelly Blue Book actually reflected. I bought a car for $23,000, and a year later it's worth over $30,000. I was like, this is crazy. I could sell this car for. I was tempted to just sell the car and ride my bike everywhere. It was just ridiculous. But Kelly Blue Book is essentially an actual cash value, and you can put that in there and get the car value, and it's probably going to be pretty close to what the insurance company is going to offer you in an accident. They even have an electric car on the front. Or the cost of repair or replace if it's cheaper. There is a coordination of benefits, so you have to be careful on that. Rental cars can create different issues. So again, if you're not sure on rental cars, call your insurance company before you go out and just assume everything's covered. And that's true for Part A as well. So just be really careful, especially if you leave the country. Be real careful. Part A, I think, is probably the more important one, that you call in advance and make sure you got the coverage you need so you understand every country. You do have some responsibilities after you have a loss. You got to notify the insurer, obviously. You have to have some proof. I haven't had any claims in quite a while, but most of them have a mobile application. Any of y'all seen that yet? You take a picture at the spot, get the police report at the spot. So it's gotten pretty automated here. Cooperate with any kind of investigation, protect the property from further loss. That's probably more important with homeowners. And then notifying the police, and especially if it's theft. And the problem with that is that they don't care. They're not going to do anything. The last guy, when I had my bike stolen, I don't think that guy could have been more indifferent on the phone. It was almost like he was trying to be indifferent, and I couldn't understand him. And he did not want to repeat himself. He must be an all day on the phone for thefts. You can imagine how old that would get after a while. But he was like, he didn't want to talk to me. Like, sorry, I just need this for insurance. But yeah, you get something from them, submit that as part of the claims process. The insurance company does have the right to subrogation, so be real careful with that. I remember one accident, this guy hit us, and he said, hey, I'll just pay you this much. And you never want to do that, because he pays you that much, $500, you get home, discover you got $2,000 in damage. You just violated your insurance contract, and you may lose all your coverage. And they have the right to your car. So if they total your car, they get the sale of the tires and whatever else they can get out of that. That's now their car. Once they total it and pay you, your car belongs to them. It does include some non-US states like Puerto Rico and Canada. Well, I guess Canada is not a territory, but covers Canada. Does not include Mexico and other countries. I know Costa Rica is unusual as well. In some countries like Saudi Arabia, insurance can even be illegal at all. So you got to be a friend of mine in the military, stationed in Saudi Arabia. He's told, don't bring a vehicle and don't bring your wife. So he brought his vehicle and his wife. And then he calls me like, I can't get insurance here. He's like, yeah, it's illegal there. It's like, I got this really expensive. So I don't know what he was thinking. He was kind of that rebel type. So yeah, anytime we travel overseas, check on that. It's getting now that you can almost Uber everywhere, or whatever they have there. So that may even, in some of these countries, insurance is so ridiculously expensive, you could probably get 2 or 3 Uber rides in a day and still come out ahead. So I would do the math. There are endorsements that you can do. Extended transportation expense when you need to rent a substitute for an extended period. Towing and labor. I don't like towing in the labor. it seems really cheap, but if you really add it up, it's very profitable to the insurance company. You know, it has to be towing and labor for a covered loss. You know, maybe you're only paying 10 bucks a year, but you know, towing's not that expensive. Remember, you don't buy that. That's what I call a low frequency, low severity event. Why waste your money? Because you know it's a loss. Yeah, I think we kind of talked about that. Okay, so part B and C for me was $122 a year, and that's a few years ago. I don't know what it would be today. So it's about $10 a month. You could probably get $100,000 of life insurance for $10 a month. And this was my question to the lawyer friend, because he does these claims, part B and C claims, so he thinks they're really common. But if you think about it, how many people do you know that were seriously injured in a car accident by uninsured motorists versus how many families do you know that suffer from a premature death? You probably can think of more of the latter than you can the former. So I'm not saying people don't have these claims, they definitely do, but it's a extremely low frequency event. And you have a lot of insurance already. Your Part D is going to cover you for your auto, your physical damage, and your health insurance, your disability is going to cover you. So you already got so it's not like you're completely uninsured. You already got the coverage. So when you talk about B and C, what did they provide? Let's talk mainly C. C is the big issue. B, just think of that as health insurance, and that's really all it is. So what can you get from C that you don't already have covered? So pain and suffering is probably the biggest one. There are a few other ancillary, like you might need to hire a housekeeper or a babysitter because you're injured or something along those lines. That would be covered. I don't consider that a really high cost. I don't have kids, so I wouldn't worry about that. And I don't care if my house isn't taken care of. You know, so there's some ancillary things. So if you really want to figure out uninsured motorists, you need to go through scenarios and think about what's everything that could happen to you. So if you're disabled and you don't have disability insurance, then go buy some disability insurance. It's going to be a lot more expensive than Part C, but that's because it's covering everything, not just when you're in an auto accident. So let me look at this debate. I haven't gotten anybody to debate that's willing to debate me on this. But under miscellaneous materials, what I did, so I went on the internet and I found several documents on this debate. And I just copied them from the internet and just pasted them in here. So these are the debates I could find. All right, so this first guy is arguing that you need B and C. Your financial losses would include medical expenses, that's health insurance, which are reasonably required as a result of such an incident. Any loss of income, that's your disability insurance, the parentheses are mine, or earnings. Any diminution of your ability to earn money. So I love how you're going to see this in a few of these. They say the same thing like 4 times. So what's the difference in loss of income and diminution your ability to earn income? Isn't that loss of income? So we can add more, you know, synonyms if we want to. Or any assorted out-of-pocket expenses such as household and related health assistance. So there's something that you probably don't have insurance for. And parts B and C would cover that. Non-financial damages such as elements as loss ability to enjoy, engage in certain activities as a result of injury. They say that, and then they say pain and suffering, but that's part of pain and suffering. And other such subjective losses for which you're entitled to monetary compensation under the law. Essentially, that's pain and suffering. All right, I don't care about pain and suffering. If I'm in pain, giving me money is not going to make me happy. All right, maybe it's because I'm independently wealthy, just don't care about money all that much. I've had some students say that's the deciding factor. If I'm seriously injured, I want a few $100,000 to make me happy. I don't know how much. If you're in serious pain all day, and I had one lady in my class say, would you be willing to be in pain the rest of your life if I gave you $1 million? He said, yeah, I'd do that. I was like, are you crazy? Is anybody, I mean, would y'all want to be in serious pain the rest of your life and get $1 million? Does that sound, I don't know. I shouldn't, some of you are saying, well, of course, but you don't want to answer now. To it just seems ridiculous to me. Pain is not, so don't give me money when I'm in pain. I mean, be nice, a nice to have, but it doesn't solve my problem. And it doesn't cost me anything. Pain and suffering doesn't cost me, the cost is the pain. It's not the expenses. The expenses are covered up here. But again, they listed it twice. So probably, let's see. So these are my, what's the probability that have died prematurely and left dependents versus seriously harm from uninsured motorists? So this last part's my argument. They argue that you could have a claim, so you should buy this insurance. We're going to see that argument again. It's just a ridiculous argument. I could argue that you could win the lottery, so you should buy a lottery ticket. Does that sound like a good argument? Doesn't make a lot of sense, does it? That's the exact same argument they're making. They're saying it's possible you could have this claim, so you better buy this insurance. That's never a reason to buy insurance. All right. So let's look at the second example. So my comments, so proving is good to buy uninsured coverage because he had a claim. That's his argument. Again, that's your neighbor who won the lottery, said you should be buying lottery tickets. I just won the lottery. Not a good convincing argument. If you know for sure you have a claim, then yeah, buy the insurance. I would agree with that. But we're talking about an extremely low frequency event, right? So you have an accident every 10 years, and when that happens, there's a 15% chance there's an uninsured motorist. So you're talking about a 1% chance, maybe, if even that. And even then, you have an accident every 10 years. It may not be a serious accident. So I guess I've been hit by cars 3 times. So I had one accident in high school. It was the other driver's fault. That was a serious one. The other 3 were people who dinged me, and I just said, forget about it. I don't care. One guy hit me in the parking lot, and he's like, oh, I'm so sorry. I got to pay you. And I said, no, it's not a big deal. And he says, oh, no. I go, it's an 11-year-old car. And he looks at all the scratches in the back. I said, I did all that. You didn't do that. I was like, I don't really care. It's a car. I don't really care. It's 10 years old. And so, I've had a few of those type of things. One lady hit me because I was turning right and I was signaling, and she just wasn't paying attention. She hits me. And I look and it says, not any damage. I don't care. And she's all upset because she damaged her car. She says, well, I'm going to tell my husband. It's like, it's not my problem. You didn't damage my car much, so I'm going home. But she's all mad at me because, well, I'm going to tell my husband, you hit me. I'm not suing you. So you should be really happy that you can tell your husband, I don't really care. But, even if you have a claim, there's a good chance you're not going to need this because it's, you have to have medical expenses. So there's a lot of accidents where there's no medical expenses at all. So low frequency. So he says, of course, the claim triggered my collision deductible 500 was going to be counted as a no-fault claim by my insurer. He's worried about raising his rates. Well, if the other person's at fault, it shouldn't raise your rates if the insurance company is looking at this correctly. Now, maybe if they do raise your rates, it's because they consider you to be partially at fault as well. We're going to talk about that later, the things we do driving that increases our chance of getting hit by somebody else. So he says, here is the beauty where uninsured coverage comes into play. Since I had the coverage and filed a police report showing the damage was a hit and run accident, my uninsured motorist coverage was triggered rather than my other than collision. But he could have done all that anyway. It's the insurance company is looking to see who's at fault. If it's hit and run, he can still tell his insurance company that and still get Part D coverage. Now, he may be out the deductible. So that can be an argument. That's the other thing is, your deductibles, you have to cover the deductible. So his deductible, that saved him $250. The damage was not my fault. It wouldn't be counted against me for my renewals. I don't think it's going to be counted against you, even if you didn't have Part C. I think that's part of the flaw is that, hey, if I have Part C, they won't count it against me. But the insurance company is still paying the claim. They're still out the money. So, that argument doesn't work. The rental car, yeah, that's that's something to consider. You can get a rental car under Part C if you don't have that coverage. Your Part D won't cover it. To me, rental cars are not that expensive. Plus, I can ride my bike just about anywhere, so I'm kind of okay with just riding my bike everywhere. This is a prime example. So I love this comment. Y'all can guess what I think about this. As with all insurance, of why it's a good idea to have as much coverage as possible. Do y'all think I agree with that? So you should have as much coverage as makes sense from the frequency and severity of the event. But yeah, insurance is always a losing proposition. You don't want to have as much coverage as possible. Without uninsured motorist coverage, I would have been on the hook for more than twice what I ended up paying up. So yeah, it could have cost him $200, $300. He's so glad he paid $100 a year. So this one event that happened in one side of 10 years could save him $300. He doesn't look like he had any medical costs. It was all property damage. So yeah, he spent $1,000 so he could save $200. So remember this the next time anyone, there I am, he's talking about me. Anyone tries to tell you uninsured motorist coverage is unnecessary if you have physical damage coverage, you never know when you will come out of the grocery store and find your door smashed and a no note left on your windshield. Are you covered? Yeah, you got Part D, pay limit on the deductible. I don't see his argument. I think he's still far behind. If he'd known this year it was going to happen, he should have had the coverage that year. But the other 9 years he didn't have that, he would have still come out ahead, not buying the insurance. Third example is the pedestrian and medical expenses, lost wages. Uninsured motorist protection can help you in another way. Let's say you're a pedestrian. So what happens when you're pedestrian, you're hit? What are you worried about? You could have property damage in the other. What would cover you on property damage? Your homeowners. So if you got a Tiffany Voss in your hand and someone hits you, yeah, your homeowners would cover you on that. What else are you worried about? Health insurance. If you have health insurance, that's going to cover you. If you carry this coverage and you get hit by a car while you're trying to cross the street, the coverage will pay your medical expenses and lost wages. If you already have that coverage, you're already covered. That could be important because even if you have medical payments coverage and health, they'll still won't pay for lost wages. But if you have disability, that will cover for lost wages. You could get coverage for your lost wages for purchasing, and you won't purchase disability insurance. You can get it automatically when you get your next job. It's just in there. I don't know if any of y'all are going to say, hey, USAA, I don't want the disability. It's already part of your compensation. If you deny it, your pay is not going to go up. I don't think you can go to USAA and say, hey, give me $400 more in pay and I'll just cancel all my disability. You've got it. It's covered. Which many people have through their employer, but it would not cover your passengers or family members. Okay, so warning, anyone gets in my car, I'm assuming you have health and disability coverage. You're on your own. Now, what if I'm at fault and you're in my car? That's that Part B. And you have medical coverage. What could you do? You don't have medical insurance. You can sue me if I'm at fault. And you can sue the other driver if they're at fault. So if you don't have medical care and you're in my car and I'm at fault, you can still sue me under Part A and then it would be covered. All right, so it's not like you're completely out in the cold, but you should have health insurance. If you don't have health insurance, don't ride in other people's cars, okay? Or at least ask them. I even thought about putting a sign in the front of my car. I do not have Part B and C insurance. Or you can lose your disability if you switch jobs. President Clinton, this was his example. He had a guy talking about his health care, and this guy switched jobs and something happened either to him or his wife and he wasn't covered, and Bill Clinton was showing this is why we needed this universal coverage. And I'm thinking, who switches jobs and doesn't make sure they have health coverage when they get the new job? I mean, it's like, what irresponsible. So I mean, would you switch jobs and say, oh, I forgot to ask about the health insurance? I mean, isn't that one of the first things you ask? Do I have health insurance coverage? If not, I better buy it independently. But that was his example. He had the guy actually stand up and people were clapping for him. Oh, this poor guy, he didn't have health. It's like, how can you, I just don't understand that. In addition to protecting you as pedestrian, it also protects you and your family members traveling in other cars. Again, we're talking health insurance. He says you probably can't afford to drive without it. Well, I've so far have been able to afford it. Are they convincing y'all to get B and C or not? Again, I've never convinced the class. You're on your own. So everybody disagrees with me, but I haven't heard a convincing argument yet. So maybe y'all will have it. Here's the fourth example. It is a very common question that we encounter in our practice. I've even heard of insurance agents who express the opinion that people do not need uninsured motors if they have health insurance or Medicare. The reasoning seems to be that for following an accident, their medical bills will be covered. Unfortunately, this reasoning fails to take in consideration all the other benefits. I love his list most of all. Available from uninsured motors. And that's what you're worried about. What am I going to lose money on that my health insurance and disability don't cover? So here's his list. The purpose of uninsured is to compensate for insured. All of the, he keeps talking like there's a million things out there that would have been entitled to receive from the person causing the accident, but who carried no insurance or hit and run. What could it be? Pain, suffering, disability, scarring, not just scarring, but even disfigurement. Is there a big difference between those two? Mental anguish, that's pain and suffering, isn't it? Loss of enjoyment of life, what is that? That's pain and suffering. Lost earnings and earnings capacity, as well as medical expenses incurred in the past and those incurred in the I don't know why I didn't come up with 7 more terms that mean scarring and disfigurement. What's in that list that you're not already covered for? It's pain and suffering. That's the biggest thing. That's what you really have to decide on. If you have health insurance and disability, it really does come down to pain and suffering. This list of damages, the only ones who would cover health insurance, Medicare would be covered medical expenses. Beyond having their medical expenses paid, someone carrying no uninsured will be struck by uninsured would receive no compensation for these other things. But of course, if you have disability, that's covered. But he mentioned 1, 2, really 3, 4, 5, 6 things that are really part of pain and suffering. I mean, that's all in that list. So no one ever believes they would be involved in a serious motor vehicle accident, but every day throughout the state, hundreds of people are seriously injured. Following a serious accident, the injured person will immediately begin to consider who will compensate them. Losses such as pain and suffering, loss of enjoyment of life, as well as loss of earnings. In the more serious accidents, all of those losses may be incurred, particularly those involved. Death, is death covered? You have life insurance, that's covered. People naturally become angry and frustrated, only discover that their own policy does not include uninsured motorist coverage. So here, my argument is, if you need health insurance, buy it. If you need life insurance, buy it. If you need disability insurance, buy it. Why would you only want it being covered when you're in a car accident and the other person's uninsured? Why is that the only time you need those coverages? Doesn't make sense to me. If there's any liability coverage available to provide compensation, even though it may be woefully inadequate, Medicare and virtually all health insurance policies have reimbursement rights. Federal, state require reimbursements. This is actually, to me, an argument for not having B and C, which the example I gave you. If you don't have B and C, to me, it's really simple. You just go to the health insurance company and say, hey, I don't have B and C. If you have B and C, guess what happens now? A big battle between these two coverages. And that's what this one lady had. If she had not had, if they didn't have B and C's, she wouldn't have to worry about it. She would have just gone to her health insurance company. In fact, I think there was 3 people fighting over it. Her part B, his part A, and her health insurance company. Those three companies are all fighting who's going to pay her claims. And she's like, someone just pay me. Federal statute require reimbursement of benefits provided by Medicare. Well, you can read the rest of that. So I need to find this Walmart case again. The reimbursement rights, Walmart got in a lot of trouble. This lady was seriously injured by a commercial truck. it hit her car. It was his fault. He hit her. And she went to court. They won the case. And it paid for a lot of her health insurance coverage. And Walmart, they had the right to do this. You can say it's evil. They probably shouldn't have done it. But Walmart says, hey, our health insurance policy says if you sue and you get reimbursed for health insurance, that money's ours because we paid your health care. So she essentially double dipping. And Walmart's saying, no, you got to pay us. It hit the press. Obviously, that looks horrible. And now the husband's saying, we don't have enough money to take care of her. If you look at the case, what shocks me in the case is how much her lawyer got. He got most of the money. And I'm kind of like, he should have sued for more because obviously he didn't sue for enough. He ended up with a lot of money. So I think Walmart made a mistake of actually doing this. But Walmart's argument was, hey, we have to do this because our contract requires it. All of our employers could sue us if we don't do this because we're essentially taking our money and giving it to her. So, from Walmart's standpoint, but I was more upset about the lawyer because he made most of the money and she didn't make enough money. But that's what the reimbursement right is if you sue someone or you get coverage, your health insurance policy can say, hey, that's not your money, that's our money. We're not going to pay you twice for this. So yeah, that's true. That is, and it's in the contract. It's what you're signing up for. And again, the only way someone may protect themselves. Do y'all agree with that? How else can you protect yourself? You buy other insurance. And then I love this phrase, is to carry the maximum amount of uninsured motorists they can afford. If you need to spend $10,000 on uninsured motorists, you spend $10,000 because that's what you need. We urge our clients to examine their declaration sheet and determine what coverage they have actually purchased and call their agents to get a quote. I mean, this is just a ridiculous statement, isn't it? Carry the maximum amount of uninsured motors coverage you can afford. Just ridiculous. I don't ever, I would never say buy the most you can afford. You should buy what makes sense. Here's on the medical payments one, health insurance. If you already have sufficient health, life, or disability, consider eliminating or purchasing decreased amounts of medical coverage for auto. Keep in mind that unlike healthcare, medical payments coverage is not generally part of HMO or PPO and may provide greater flexibility in care. So it may be a little better, and that one out of 100 times that it actually happens to you. So you got to think about the frequency and severity, what you're actually paying for. And my bigger point is, it's $120 a year. You could buy other coverages. Let's say someone doesn't have health insurance. 120 bucks is not going to buy much health insurance, but it will cover some health insurance. And my thought is they need to focus on getting health insurance, and this will at least help take care of that. Our life insurance, All right, so what do y'all think? Anyone make a strong argument for buying B and C? I mean, I'd love it when y'all disagree with me. So you're going to go home and you're going to keep it, right? And why are you keeping it? Well, who here doesn't have it? So y'all all have B and C, right? So explain to me why you have B and C. What's the main reason you have? Because you're spending $100, $200 a year. In fact, you're probably spending an unknown amount. Isn't that the right answer? You're spending an unknown amount. What if it's $7,200? Well, that'd be higher than your premium, so you know it's not that. But what if it was 300 bucks? Would this be worth 300 bucks a year to you? Mine was 122, but I'm with UTSA and I've been there for years. So, and that was a few years ago, so it's probably much. I should go price it again. It's really easy for me to price this. You can do this probably online. You just click it on and click it off, and they'll show you the premium change. I calculated it online in a couple of minutes. So why are you going to keep it? Your number one reason, is it pain and suffering? Is pain and suffering important to you? Someone's got to say something. Someone's got to defend this class and why you're buying B and C when your professor is saying he doesn't think it makes sense. I mean, well, look at that list, though, my word. It's a long list, isn't it? Let's say you have major disfigurement, which is pretty horrible, right? I know people that in a fire or whatever, I mean, it's horrible. With getting some money after that, relieve some of that for you. Say, well, you know, it's terribly disfigured, but boy, I got 200,000 bucks. So I feel compensated. Does that feel like you've been compensated? To me, the only thing that's going to compensate me is go back in time and undo it. That's the only thing that would compensate me. So, but some people say, well, at least I got the 200,000. But that's kind of the lottery ticket argument. All right, I'm not going to be able to pull anything. How many of y'all are going to keep your Part B and C? How many of y'all don't know? All right, are you going to at least think about it? All right, if you cancel it, don't tell me because you're on your own, because you have an accident the next day and you got to make your own decision. I'm not saying it's a bad decision. I'm saying it's a bad decision for me. My lawyer friend thinks I'm an idiot for even saying this, but he's a lawyer that these are his claims. Obviously, he wants people to have uninsured because that's how he gets compensated. So he has a little bit of a vested interest in this. I forget what, oh, I have to go back to my Facebook. We had a big Facebook debate on this. I shouldn't even gotten into it because, you know, obviously he's on Facebook as a lawyer trying to get his clients, and I kind of commented, I don't think it's worth it. But what was her argument? I thought it was a ridiculous argument. It's had something to do with pain and suffering. But my argument is I just don't care about it. But I have to go. I'll see back. It's been a while, so I don't know if I can find it on Facebook anymore. All right. Well, think about it between now and next class, because I want to have some debate on it. But at least between now and next class, go see if you have it and how much it costs you. All right. At least do that. If you're on your parents' policy, I don't know. Can you ask your parents to? Say, why are you asking about auto insurance?
Yeah, I got mine pulled up right now. Go it for this class or?
Well, if you want, do you have B and C?
Yeah, I got uninsured. I do have some liability and injury coverage as well.
Well, you have to have liability. Yeah, so it's gonna be Part B and C. It'll be B and C, medical coverage and uninsured motorists.
That's insured.
Can you quickly see what the premium is?
Oh, shit, you know.
Well, try it between now and next class. Let's try. Yeah, look it up. So you just go online and they usually have you have your auto policy. When you go in there, they'll have a button, at least USAA does. My guess is Allstate and State Farm do too. Where you can go and you can reprice. You can just take. They'll give you all kinds of warrant. I mean, if you call them and ask if I should cancel, that's the one thing. If someone says, "Yeah, I'm going to cancel B and C," if you call them now, you can do it online, and they'll probably call you. But if you call them and ask, oh, they'll scare you to death. But you should try it. Maybe you should call and just see, hey, I got this weirdo professor who doesn't have B and C. I'm kind of thinking about it for myself. They'll scare the wits out of you, no question. But then ask them those questions. I have health insurance. I have disability. I don't care about pain and suffering. Tell me exactly in a scenario where I get hit and I'm terribly disabled. I have life insurance. If I get killed, you know, that life insurance to cover me. So go through every single thing, and they'll probably give you a list like this where they'll say the same thing 3 times. But at least my main point is don't buy insurance without thinking about it, because remember, it's a loss. You're losing money on average. At least make it a very conscious decision whether you have it or not. All right, so where are we going from here? And Enrique, if you figure that out, you know, I'd be curious what y'all pay, because my guess is 21, 22-year-old males are probably paying more for it than old guys like me. So,
Well, I agree with you because when I got my motorcycle, my medical was covered by my health insurance.
Yeah.
My motorcycle paid that in like 2000.
Oh, you had
paid
medical?
for my motorcycle, sure, but medical wise, they didn't
Yeah, your Part D came in, yeah. So you have motorcycle insurance.
Right.
Yeah.
I only paid $300.
Yeah. I'd be curious on motorcycle if the medical coverage is a little more expensive because, you know, the injuries could be more. I don't think they make a distinction between a motorcycle and an SUV for the medical. The Part C probably doesn't matter because your property damage will be much lower. So yeah, you know, it's something to think about and at least know what you're paying. All right. Don't buy insurance without making it a conscious decision. And you know, you should be buying level term, but if you don't have any dependents, even that, it's not that important of a thing to do. I saw Judge Judy where this grandmother bought life insurance on all of her grandkids. And Judge Judy's like, why did you do that? Why would you do that? Oh, I just wanted to help their financials. Like, yeah, it's really bizarre. All right. So where we're going to go, we won't start it tonight, but I just want to show you, we're going to talk about credit scores in Texas and their impact on auto insurance. It's a very touchy topic, no question. Some stuff may make you upset. Here's Jose Montemayor. He's the one that spoke to my class a couple of times. Really smart guy. But there were two studies done. The first study we're going to do second. And what we're going to start with is the second study, but really all we're going to do is focus on the letter Jose Montemayor sent to the Texas legislature, because in this letter, he covers a lot in a very short period of time. And one thing that's real important that you want to read up on before class to get into it is the 3 types of discrimination. All right. I don't like the titles of them, and I actually don't require you to get the titles right because I think they're flipped. I think they're backwards. But there's unfair discrimination. There's intentional discrimination. These are both illegal. And there's disproportionate impact, which is not illegal. All right. So the question is, are credit scores unfair discrimination? Are credit scores intentional discrimination? Or are they disproportionate impact? They're absolutely disproportionate impact, no question. So that thing's going to come back. Is it unfair discrimination? So read this paragraph in particular because it's really central. So what you're going to see, especially on the exam question, is there's 3 questions they're asking. Is the relationship between credit scores and accidents, frequency and severity? The answer to that is absolutely yes. Is there a disproportionate impact? When you use credit scores to rate policy, does it disproportionately impact certain groups of people? That's absolutely true. And then the third one is it just coincidental? So we know young people have bad credit scores and young people are worse drivers. Why don't we just use age? So does credit scores provide additional information over other factors? And the answer to that is yes, it absolutely does. So it is predictive, it is disproportionate impact, and its prediction is unique to credit scores, nothing else. So those 3 questions. So as you read through it, you're looking for those 3 questions. Okay. So we'll do that. I'll let you out a little early, but that's what you're after, right? So make sure you read that. You can get away with just reading the highlighted sections. So I'm hitting some of the big issues out of the last 30 years of property and casualty. I'm waiting for the next big one to hit. COVID did raise some issues, but they ended up not being that major. So I'm still waiting for the next big issue, but this was a huge one. This is still a big issue. Some states, it's a bigger issue than others. So I want to start with this second article. And so the real key to this is start off, this is an exam question on the second exam. So that the real key is to know the rubric, what's part of each rubric. I don't know if I have the rubric out here. I'll have to show it to y'all when we do the end of it. But how do you understand an issue like this from the insurance company standpoint, but also the consumer standpoint? And understanding insurance is a unique business and that it's legally allowed to discriminate against people, but within some restrictions. And it can discriminate on stuff that almost no one else can, like age or gender or those kind of things that probably no one else has that right to do. So Jose Montemayor, he's setting up this whole issue in the second letter, in the second study. So there's two studies. In the second study, he writes a letter to the Texas legislature and to Rick Perry. I don't know if y'all know Rick Perry. Remember Rick Perry, probably before your time. David Dewhurst. Man, these are old names. I think they're all three still around, still alive, but Rick Perry ran for president. But really going to the legislature asked them to do this study. And so it's a big part of this discussion is the disproportionate impact. So he's saying, now when he spoke to my class, he was he said disproportionate impact, there's no such thing. Everything in insurance has some kind of impact. It's not going to hit every group exactly the same. So he said, just ignore it. It's a crazy idea, but yet in this article, in this paper, he makes it, a legitimate thing. But he says, well, we know there's disproportionate impact. There's no law that tells when you've gone over the edge, when you've gone too far, when you know you're excessive disproportionate impact. But that's what disproportionate impact is. It's underrepresentation of various credit score categories in terms of certain categories that are uncomfortable for the insurance industry. But we'll get into that. Why would this be legal and other things aren't? And it gets down to almost cause and effect kind of thing. So there's two phases. So let me just organize it. It's in the class notes as well, but just organize it so we know exactly where we're going here. So phase 1 and phase 2. We talked this last class about phase 2. So there's 3 questions, which is essentially the outline for your answer. There's 3 questions. You got to answer those 3 questions. So the first question is there a relationship between credit scores and claims? And here we're going to ask in terms of frequency and or severity. We're going to see the whole mold issue is going to come in, because molds, one thing you're going to talk about in this study is, well, when it comes to homeowners insurance, we had some noise in the data because of the mold issue in Texas. So we're not 100% sure on the homeowner side. So they're looking at homeowners. I should have said that. This is homeowners and auto. It's both. Now, are they talking liability or property? Most of this is property type of events. I don't know if they really even make that distinction. So is there a relationship? And then you need to make sure in your answer, is it more related to frequency or more related to severity? And then the answer may be slightly different between homeowners and auto. Okay, so you have to think about that. And then the second question is there a disproportionate impact in the use of credit scores? Disproportionate to whom? So that we got to talk about age, gender, race, religion, ethnicity, who's getting harmed by this. And he has a great phrase in there, is the use of credit scores. I forget the exact word he uses. Let's see if I can find it here. Y'all got to get me to stop clicking on Chrome.
Look,
Where is it? Here it is.
just slide it other way, sir.
Yeah, I should unpin it, but let me see if I can find it. How do you spell sinister, though? That's not a part of my pillars. CY?
Yes. That's like,
It's SI?
it's by NI.
Is all right. Here it is, right here. Sinister. How many times do you use the word sinister in So I love this phrase. A surrogate for something sinister, a good alliterative phrase. So here's his way. So essentially what he's asking is if it's a disproportionate impact, is it disproportionate because credit scores are just a substitute for something that is illegal? That would be a surrogate for something sinister. I don't know how much time he spent coming up with that phrase, but that's a great phrase. So that's really what he's after here. Not just does it have a disproportionate impact, but is it in such a way that it could be illegal? That's the only way disproportionate impact can be illegal, is if it's just a substitute for something else. And that gets us to phase 2 as well. Now, he says some stuff in these letters that he didn't say to my class. So I don't know if he cleaned them up and made them more political because he certainly didn't clean that for the class. It's pretty obvious he was telling us what I really thought, because he was pretty blatant. I guess once you retire and he's doing well, I was like, I'll just tell you the truth. But he said at the end of the first study, I had this concern that credit scores, while they are predictive, that they don't add any additional information. We have everything we need with age and gender and driving history. We have all this other stuff. That's enough. So the second phase was, do credit scores provide additional information on frequency and severity not found in other variables? So that was their last question. I forget exactly how I said, but he has it worded pretty well there as well. But does it tell us something that we can't get from the other variables? Now, he says he suspected that the answer to that was no, that we have everything we need and we don't really need credit scores. He didn't say that in class. He said in class, yeah, I've always known credit scores were perfectly fine and very predictable and very useful. But in here, maybe he's trying to, kind of keep the politicians happy. So there's his question. So your goal in answering is to answer each one of those. So phase 1 is what the legislatures asked them to do. Phase 2 is the question they themselves raised in doing the study. The legislature didn't ask them to ask this third question. That's something they come up on their own. All right. And so the answer is already told you. The answer here is yes. It is strong. Here, the answer is yes and worrisome. And the answer here is yes. And I think they used the word significant. I don't know how to spell worrisome. So it's not beautiful, but I guess you could say yes and worrisome, but not illegal. That's what Montemayor says. Yeah, you know what? There is disproportionate impact. It's for groups that were real uncomfortable there being disproportionate impact. It's worrisome, but I can't do anything. It's not illegal. If you want to make it illegal, legislature, you got to make it illegal. There's nothing in existing law that says insurance companies can't use this. So that's his final answer. So you see where we're going. In doing that, they define the 3 types of discrimination: 2 illegal, 1 legal. So you want that in your answer, because that's pretty important to understand. As far as I know, no other state has done this. So the whole country is watching Texas go through this. And they got data from the insurance companies were more than happy to participate in this because they already knew the answer. So they weren't like withholding information. They say, tell us what you need, we'll give it to you, because they knew they were going to come out ahead. And remember, Jose Montemayor has a very quantitative background. He's a statistician. He got a CPA just so he could become insurance commissioner, but his real background is math and statistics. And so this was right up his alley. This is the kind of thing that he would do. All right. So here he talks about the second phase because this is the report for the second phase. All right. So the second phase of the study evaluates if and to what extent, so I guess there's really two parts of it, credit scores enable an insurer to more accurately predict losses when used in conjunction with other variables. And here's the word, significant. Credit scoring significantly improves pricing accuracy when combined with other rating variables in predicting risk. And by risk, he's talking about frequency and severity. Significantly improves. It's not just, telling you the same thing the others tell you. It's actually giving you additional information. And he put the word significantly in there. He didn't say somewhat or does improve something, he said significantly, which is almost a statistical term, isn't it? You use the word significant in statistics to mean something. I don't know if he was being that precise here, but you certainly get that. All right, let's talk about these three discriminations. Unfair, and again, I think they have unfair and intentional reversed the way I understand these words, but anyway, you can see if you agree with me. Unfair discrimination is illegal, intentional discrimination is illegal, and disproportionate impact is legal unless it's just substituting for something one for one. All right, so if, let's say we had people with green hair and red hair, and people with green hair, they're worse drivers than people with red hair. I'm not saying that's true, but let's say it's true. But let's say it's illegal to discriminate based on hair color. But then we discover that you can absolutely predict someone's credit score by knowing their hair color. If they have green hair, they have a bad credit score. If they have red hair, they have a good credit score. So credit score perfectly predicts hair color. Then you can't use credit score because it's just a substitute. However, if you look at green-haired people and there's people in there with good credit scores and bad credit scores, and the one with good credit scores drive really well, and the one with bad drive really poorly, the fact that green-haired people have lower average credit scores is not illegal. Because within green-haired people, it's not perfectly predictable. You can't predict, so that's what they're asking here. To be disproportionate impact, it can't just be a substitute for an illegal variable. So text code defines unfair discrimination to be the unequal treatment of people who are you can read this as the same risk. So two people have the exact same risk, frequency, and severity. You can't charge one more than another. Another way of saying this is all pricing variables must be actuarially sound and documented. You can't go to the state and say, I'm going to charge this group more than this group without a full-blown study that proves that's the case. Right? That's unfair discrimination. To me, that sounds like intentional discrimination. In my mind, you got red hairs and green hairs. They both drive the same, but I don't like green-haired people. Just green's not my favorite color. Let's just charge them more. That seems unfair. I mean, that seems like intentional. You're just discriminating just to, but it's not. That's unfair discrimination. But anyway. So if they're actuarially supported, they're not unfair. That doesn't mean you can do it just because it's actuarially supported. So this next group, even if they are actually supported, it's illegal. So discrimination is based on race, color, religion, national origin. That's intentional discrimination. They are prohibited by law. Now you notice gender is not in there, age is not in there. There's things they can discriminate on that other people can't. But those are illegal. All right, so y'all see those two definitions. Now, disproportionate impact, he gives kind of an extra definition here. And I think part of the reason he's doing that is he says this term doesn't exist. This was a made-up term, and we just had to use it. So he's somewhat defining it so he makes sure everybody knows this new term that's just been created, what it is. So disproportionate impact is a lack of symmetry or unequal percentages. In other words, disproportionate impact is an uneven distribution to each racial group within a given risk, although the uneven distribution is not caused by one's race. Now, race is not the only one they looked at. They looked at gender, income. Oh, we'll see. So there's disproportionate, you know, it's going to affect age because young people tend to have worse credit scores than older people. You know, it's going to affect income because you assume rich people will have better scores than poor people. Did you know there's really rich people with bad credit scores? You know, it seems kind of incredible, but there are rich people, but it's disproportionately rich people have good credit scores and disproportionately poor have bad credit scores. So there's other things they studied and we'll see those. By the nature, so here's what he's saying is get over it. Disproportionate impact is just the nature of the business. By the nature of risk-based pricing, all factors used in insurance have a disproportionate impact to some extent. One can make a convincing argument to ban the use of all risk-based factors based solely on this. Effectively, we would ban all risk-based pricing and underwriting, revert to a pricing system where everybody pays the exact same rate. Does he like that idea? That would be a setback to all Texans of all races, especially those moderate to low income whose risk remains low. All right, so would you want a case where everybody has to pay the exact same rate? Someone with 20 speeding tickets and 14 accidents would pay the same rate you would pay. Would that be fair? And so he's saying, no, that's not fair. We should charge people based on those actuarially determined factors, as long as it's not one of these. Now, there are countries that do prohibit it based on gender. So I think France, I don't know if they changed it, but France has had laws that you can't charge men and women different rates for insurance, which means what? Women are going to pay more for auto insurance. They're going to pay more for health insurance, less for life insurance. I think men come out ahead on that one because we're much more dangerous than women when it comes to these type of risks. But on life insurance, yeah, they'd come out ahead on that. So are you really helping anyone? You know, you have to say, are you really helping women? You probably are actually causing them to spend much more than they would. So here's where he says, this study did not support those initial suspicions. Someone implies that he was questioning that, but he didn't have I can assure you what he said in my class. He did not have those suspicions. He was quite convinced that wasn't the case. Credit scoring, if continued, is not unfairly discriminatory as defined in current law, and that's because, you know, you look back at unfair discrimination because you remember that's the one where you don't have the actuarial support. As defined by current law, because credit scoring is not based on race, nor is it a precise indicator of one's race. That's where that surrogate for something sinister comes in. You can't perfectly predict one's gender, income, race, just based entirely on credit scores. All of those groups have different levels of credit scores. And I think it's real important too, within each one of those groups, people with good credit scores drive better than people with bad credit scores. So that's very consistent in every group. All right, so there's his signature. He does have some good, you know, he's a little bit of a politician. If the presence of credit scoring insurance will only feed suspicion and divide us as Texans, that sounds like a politician, doesn't it? Its continued use to any degree may simply not be worth it. Now, he doesn't address the issue that I think is really, really important, but he hints at it. If we eliminate the use of credit scores, that's California. You cannot use credit scores in California. Does everyone win? I think that's the way it was pushed in California. This is unfair. We shouldn't be harming Californians by using credit scores. And the answer to that is obviously no. People with bad scores get premium discount, and those good scores will pay more. Much more. So let's see if it's materials. So if we go to the first article, I had it saved, but I have to reload it. You'll actually see how material it is, and it is definitely material. So this is on personal auto. Here's the rate impact. It can reduce your rates as much as 40%, and it can increase your rates as much as 60%. And I know you say, well, most are right in here, but that's 20%, 10 to 20, 20 to 20%. 20% is still a pretty significant impact on your insurance. That's a few $100s a year. So it's pretty material, but even 30%, you have 10% that are saving 30%. You have 10% over here that are spending 20 to 40% more. So it's definitely material. All right. So we're not talking 5%, 10%, we're talking 20, 30% types of rate impacts. And there are a lot of people. So you got about a third that it's between negative and positive 10%. That means 2/3 is more than 10%. So it is material. All right. You got to make sure, this is something that you want to have the graphs that they show. Their graphs in this first study. You'll notice once you get to the appendix, my highlighting stops. And the reason it stops is I find a lot of these charts very, very confusing to read. I don't know who put this together, but they didn't put it together. I would. So I would not, if I were you, when you get to the appendix, unless you're just want to get into it in detail from like an actuarial standpoint, I wouldn't worry about these. They're really difficult to read. And part of what they do is they broke it into so many different groups, and it's just a lot of data. I don't think they really explain it very, very well. So it gets a little frustrating to try to figure out what they're doing. All right, making sure I'm sharing here. All right, so let's get into it. So here's the first study. We're just going to focus in on the highlighted things. So 6 leading insurance groups. I don't know if UTSA was in it, but probably so, because they're the 5th largest auto insurer in the country, at least at this time. 2 million policies. So it's a pretty good sample size, 2 million policies. 1.2 million for auto, 800,000 for homeowners. All right, so that's the sample size. Now, how do they pull the data? Is it possible the insurance companies fed data to prove the point? Who knows what kind of controls they had in place. And so here's, I asked the question in a different order. The department uses data to analyze whether the use of credit score impacts certain classes of individuals more than others, and if it predicts claimed experience. All right. So the answers are yes and yes. So the policy, the data shows a consistent pattern of differences in credit scores among different groups. So there is a disproportionate impact. There appears to be a strong, so again, he's using strong, significant relationship between credit scores and claims experience. It is necessary to evaluate if and to what extent credit scores enables the insurer to more accurately predict losses. And so that's when the second study came in. The department is in the process of conducting multivariate. So this is important. This was a univariate study. This was a multivariate study. So here they just looked on this first study, just is a relationship between credit scores and frequency and severity. Here they said, when we bring in all these different factors, and there's a lot of them, you'll see the list of all the different factors, we bring them in, does credit score have a significance on all into itself? So they didn't ask that in the first study, it just kind of came up as part of the analysis. They couldn't get income data. And so what they did on income is they just guessed the people's income based on zip code. So they did have zip code, and they probably got them fairly accurate. So while the differences in average credit scores between income levels are not as large as they are for other groups, the data shows that the average credit scores for other incomes are better than those for lower income. Like, duh, we knew that. The moderate income level populations tend to be overrepresented and the worst in credit score categories and underrepresented in the better than average. The individual policyholder data shows a consistent pattern of differences in credit scores depending on age. Obviously, you knew that younger people have worse scores than older people. So this is a big issue because young people already pay more for auto insurance just because they're young. And this is going to be a charge in addition to that of another 20–30%. So it feels almost like piling on, right? It's just like, give us a break. We're already paying enough. And you're going to make us pay more just because we don't have 7 credit cards with history. But yeah, that's what they're saying, younger people. And then the question is, well, maybe age is enough. We don't need credit scores. Let's just look at their age. I guess what happened to complaints when people started realizing credit score was part of their policy pricing, and the number of complaints increased substantially. They actually have a graph of that somewhere in here showing the number of complaints. We'll see it here pretty soon. Now, who's complaining? People with good scores or bad scores? Probably people with bad scores, you would think. I mentioned y'all that a local radio station had this as a debate, and all the people calling in were mad. I didn't hear one call and say, "Wow, I love it because I've got a good credit score and I pay less." No, they were all people coming in screaming, "Why does this? Why does it have anything to do with my driving?" So not everybody uses credit scores. 42% of homeowners, 55% of auto premiums use credit scores to some degree. These numbers do not include those insurers. So there are some, and this is we're going to see with Allstate got in trouble in California. There's some that say we don't use credit scores to price policies, but however, if someone has a bad credit score, they've got to pay their entire premium upfront. And what did that do? That's going to essentially make people with bad credit scores not buy from Allstate. And the state sued them and said, "Hey, that's going to give you the same answer. You may not charge them more, but they're not going to buy from you because you're making it really difficult." And they said, no, they have bad credit score. We need all the money up front. And that's not a very strong argument because if you don't pay your premium, you don't have coverage. It's not like Allstate's giving them coverage without the premium, so if you don't pay your premium, you don't have coverage. So it wasn't a very strong argument from Allstate's standpoint. So some use credit information for other things beyond just pricing the policies. If this is used included, so here they're talking about use credit scores for who they accept or reject, not just in pricing. So that obviously would be the ultimate example of credit scores really harming people with bad credit scores. If this use included these percentages increase to 54 and 82%. So 82% of auto either price it into the policy or they reject you based on your credit score. The rates varied as little as 11% to 14%, 400%. So there's a lot of noise in the numbers. All right, so here's kind of the first thing I should have read, but the insurance code, section 15 requires the Texas Department of Insurance to present a report to the governor regarding the use of credit information by insurers in Texas. So they're just answering this, and this is their report. Any of y'all work with credit scores in here? Banks, or y'all seen them? Do you know your credit score? Y'all looked it up? Yeah, I have no credit cards. I have no debt, so I never look mine up. But I always think it's like should be 800, right? But it's not. I'm like, why do you like, how could I possibly not be a good credit? But credit scores are typically in a model, so it's just the statistics. The inputs are number of credit cards, how many collections you've had, and the output is a single number. And the nice thing for insurance companies is a single number based on a lot of data that's very easy to get their hands on. And what's one of the complaints you've heard about credit scores is there's a lot of errors in these credit scores, bad data. And so people are getting bad credit scores, not because they're bad credit risk, but because some piece of information got miskeyed, maybe their income or something got miskeyed. And that's been a big complaint that some of these firms, I have a former student working for Equifax. I forget what department he's in, but yeah, I mean, that's a big complaint that he says they get is, you know, why don't you fix your data faster when someone has, so there's been some legislation that if someone has a problem with a credit score, these credit agencies need to have some process to fix it quickly and not just let them, you know, hang out there with a bad score. So I don't know, all the data, we could probably find it. Yeah, I'm gonna get a million things about the SA credit scores, right? Because everybody sells them. Credit Karma, y'all probably gotten stuff from them in an email, haven't you? What factors affect your credit score? I don't know how good this site is. Payment history, that makes sense. Credit utilization, what is that? Can't remember. Is that, do you use it too much or you don't use it enough? It's too much, okay. The amount of available credit. Oh, okay. Yeah, I'm not sure on mine. I use my credit cards all the time, but I pay the full bill, so I don't know if they see my outstanding balance and they consider that to be high usage or not. I don't know. Length of credit history, obviously young people, that's where they get hurt. Mix of credit types, recent applications. So your application itself can cause some issues. But payment history and how much you're loading up is the factors they're looking at. All right, so what did they find? So here's the complaints. You can see a huge increase in complaints. Now, I don't know if you know, you can complain to the Texas Insurance Commission. What I do, I've had some problems with life insurers. I don't think I've had problems with P&C insurers. But when I worked at UTSA, there was a department called Presidential Complaints. And I go, well, that's interesting. There's a whole department. So I started making all my complaints to the president of the company. I would just find out the president and I would send it to the president. And boy, I was amazed. I had this whole department working for me. So yeah, make it a presidential complaint and you get special treatment. But you can complain to the Texas Department. They do have an investigatory body as well. They can put pressure on insurers, but writing a letter to the president of the company is probably the most powerful. There was one time I got so mad, I actually wrote a letter to the president of the company and I copied all the board members of the company because I was just so irately mad. And we did get our money back, so it did work. All right, so we saw that range. This is auto. Chart shows that insurers started using expanded credit. The vast majority, 90% experience swings from 40 to 40%. Almost 10% of policyholders, it was more than 40%. So 90% are within 40. 40 is a pretty massive numbers. So for homeowners, the impact was not as dramatic, but 30%. So you can notice on the homeowners, they're going to talk about how the mold issue in Texas really messed up some of these data, especially when you're trying to look at severity, because mold was somewhat skewed and it was hit right when the study is being done. All right, there's that word availability. Very, very important word. Availability, affordability, adequacy, those are all words you hear a lot with insurance. So from an availability standpoint, insurance companies argue that the use of credit score improves their ability to provide insurance. Essentially what they say, there's some people in areas that it's hard to get insurance, but if they got a good credit score, they can get insurance. So it kind of gives them an out. Something I want you to think about in here, it doesn't come up in here, but could telematics replace credit scores? We're talking about false positives, aren't we? What would be a false positive here? I guess false negative as well. Maybe I don't think about it right. What would be a false positive? Someone with a bad credit score that is a good driver. Is that a false positive or a false negative? I'm not sure which, but let's say false positive. You could probably argue it either way. All right, so that's bad, isn't it? Someone has a bad credit score, but there's just a wonderful driver. What about a false negative? What would that be? Someone with a good credit score that is a bad driver. Now, the thing here is other factors will probably catch this. So there's probably something else that they have that might catch that. But could telematics be the solution for this person right here? That's why I say telematics is a really great paper topic for paper 2, because it really is having, it's not just telematics, but it's artificial intelligence. Not only are we monitoring how people drive, but we're actually letting the computer do all the work for us. So if someone has a bad credit scores, then get the telematics, prove that you're actually a good driver. And maybe that's what the state law could say. Hey, if you're going to charge someone more for credit scores, you got to at least give them the opportunity to use telematics and prove they're a good driver. And then after 6 months, if they prove they're a good driver, you have to reimburse them for what you charge them for. You could do something along those lines to somewhat offset it. So telematics to me might be a good solution to get around this. Now, telematics itself, you can't use telematics for pricing unless you can prove there's a relationship to driving. So you still have to be actuarially sound, but that's what insurance companies are collecting right now.
When I've seen the telematics, most people are bad drivers, don't want to use it.
Yeah, and there's probably some indication there where if someone gets telematics, they already get a 20% discount just from the fact that they get it.
And typically, the people who will use the telematics, they're usually getting an additional discount, not because it's, I mean, not a.
But this is a way if someone says, hey, I got bad credit score, but I'm a good driver, the insurance company can say, well, we got something perfect for you. You can put this in your car and we can see if you're a good driver.
Then there's Big Brother. I get that.
Yeah, people don't like it, but they say, hey, that's all we have to offer you.
Yeah.
If you don't want Big Brother, then you're going to have to pay more for insurance with your bad credit score, or you got to fix your credit score. I mean, those are the only, we're running out of options here. So, that's, they can do what they can do. And I don't know what California says about telematics. It'd be interesting. Every state's going to have their own rules. So they're arguing, insurance companies saying availability. There are people out there that can't get insurance, but because of a good credit score, we can now give them insurance. That gives us enough confidence that we can provide insurance to people who did not have it before. It benefits consumers because insurance may become more available and may be particularly beneficial to more marginal applicants who might otherwise be declined. On the other hand, the increased rates for policyholders with below average credit may make insurance there's the other word, unaffordable. Availability, affordability. So availability is great for people with good credit scores. Affordability is horrible for people with bad credit scores because they're probably already in a tight position if they have a bad credit score. So is there a difference between unaffordable and unavailable? And some people say no, if it's not affordable, then it's not available. If you can't afford to buy it, then it doesn't matter. It's available for you for $6,000 a year. It's like, yeah, that's not available for me. And this is true for all rating variables, not just credit scores. Some consumers may question the relevance. So this is an important concept as well. I see this a lot. Corey DeAngelis, y'all should all follow him. But he talks a lot about education reform, and he always has to make this distinction. Correlation is not causation. Have y'all heard that before? Correlation is not causation. I heard a perfect example not too long ago, but I can't remember what it was. But I mean, if you put a bucket in your front yard and you measure how much water is in it, and you also note the weather, and after you do that for a year, you discover anytime there's water in the bucket, it's rained that day. So you conclude that that bucket full of water is causing it to rain. That'd be kind of a illogical conclusion, but the correlation would perfectly fit with that. So are the credit scores causing people drive differently? And the answer there is, I think most people say no. My credit score is not changing the way I drive. So what is probably going on here? There's probably a third factor that does relate to driving. What might that factor be? I don't know, just keep it generic. Maybe it's personal responsibility. Maybe people that are personally responsible have good credit scores, and people who are personally responsible are good drivers. And so personal responsibility is really the key. We want people that are personally responsible. If we can find those people, we can loan them money and we can give them auto insurance. Well, how do you find out if someone's personally responsible? You put on the application, are you a good person? And 99% say yes. How do you find that out? Well, personal responsibility causes good credit scores. And so we can, through the back door, find out that they're responsible people by using their credit scores, and that can now be used for driving. And from an actuarial standpoint, they don't care. Actuaries don't care about causation, they care about correlation. And in fact, it's actually possible you use what's caused to figure out what is causing. It depends on what you're trying to insure and looking at. So, and actuaries don't care. If there's a relationship, it's reliable, statistically significant, it works in different groups over time, different countries, whatever. If that's the case, we want it. So this is probably the true factor. Is there other things they could do to figure this out? Then maybe they could do, you have to have references, but anything else you do is going to be a lot more difficult than the ease of credit scores, which you can get in a file in a few seconds. You just pay Equifax a few dollars and you've got it. So that's what we're taking here. Is consumers may question the relevance of the credit score to the risk or probability of insurance claims. Other things they tend to be okay with. Most people are okay that young people pay more than older people for auto insurance. Are y'all okay with that? You're the ones having to pay more. Do you really become a great driver when you turn 25? The night before your birthday at 24, you're just this horrible driver, and the next morning you wake up and you just become a great driver? Or is it just, it's kind of random age change there. Driving record, most people agree that people get a lot of speeding tickets and have a lot of accidents, are probably going to continue that into the future. That probably makes sense. My telematics looks to see if I use my cell phone while I'm driving, which I don't. I've gotten, that's one thing I'm never going to do. I just turn that thing off, put it off to the side. It asks if I do hard braking. It scored me bad on that once, and I have no idea what they were seeing because I don't remember. I try not to use my brakes if possible, so I don't remember doing any hard braking there. So I look at the things that the telematics looks at. They ask if I do hand-free calls as well. I don't know how they can tell between hand-free versus the other. I don't know exactly what they're measuring. But yeah, most people say, yeah, I can see that relationship because you're distracted as a driver, or young people tend to be more aggressive or whatever. Men are worse drivers than women, especially at young ages. Why do married men drive better than unmarried men? I don't know.
So this, because there are kids in the back or something?
Yeah, I saw it with my brother. He was a horrible driver. I would walk home for 30 minutes before I would take a ride with him. He was a horrible driver. And then 10 years later, I'm riding with him, and it's like I'm riding with my grandmother. It's just like this. And he rode with me from the airport, and he's like, oh, what are you doing? Be careful. And I was like, yeah, I'm driving a whole lot better than you used to drive. But so he changed over time, and it probably was the kids that changed them. The actuaries care? No, they have the data that tells them. But most people are comfortable with those other things because they can visualize it. Credit scores is the tough one. They just don't see the relationship. But there must be some because the data is pretty strong. So a lot of data in here. you can see the individuals and the breakdown. The 18%, 19% were unknown, so the databases they were pulling from weren't all that strong. Okay, I don't like that graph, but I do really like, this is the graph you probably want to put in your answer. All right, well, let's do this before we look at the graphs, because this is important. So there's two ways you can look at this: pure premium or loss ratios. What pure premium means is, what is the premium you should charge such that you exactly cover the expected losses. In life insurance, we call it the net premium. So it's if all you did was you collected premium, you paid claims, you didn't have any expenses, no profit, what is that premium you need to charge? So the higher the pure premium, the riskier the person is. All right. Loss ratio is a little easier to understand. The loss ratio is your claims divided by your premiums. All right. Remember, the combined ratio is the loss ratio, the LAE ratio, and the expense ratio. Y'all remember those three things? Loss ratio is your claims over your premiums. Adjustment is your loss adjuster expenses divided by your premiums, and then your expense ratio is all your other expenses. So the loss ratio is just the claims. This is the stuff you're actually paying for losses over your premium. And so they use one for auto and they use the other one for homeowners. They even get a little more definition here. Pure premium is defined as a dollar amount of a basic limit, 20,000, 40,000, 15,000 losses per vehicle per year. A pure premium 200 means that on average, insurance claims are $200 per vehicle per year. Loss ratio is the dollar amount of losses divided by the dollar amount of earned. We'll talk about this later. Why earned premiums, not written premiums? So we'll have to see. We'll see the difference in those two. Insurance companies, especially actuaries, are real precise whether it's written or earned. A loss ratio of 70% means that incurred, we'll talk about the word incurred here as well. Incurred losses amount to 70% of premiums. And that's a pretty typical loss ratio for auto insurance. Auto insurance might be 70% loss ratio, 5 to 10% adjuster, and 15, 20%, 25% expenses, and then 5% for profit. So 70 is a pretty typical one. All right, so for auto insurance, they're using pure premium. And this is the chart you probably want to have in your answer. So along the bottom is they put credit scores in the deciles. These aren't actual credit scores, but they're decile. So 1 through 10. And over here is the pure premium. And so what they're saying is the worst credit scores, their pure premium should be 350. The best credit score, their premium should be about 175. So there's about a 100% difference. This is twice that. Now this is per year per vehicle. So if you have 2 or 3 vehicles, but it's not per household, it's per vehicle. The average should have paid about $250. So the worst is $100 more expensive. The best is about what, about 75 cheaper. So do you see a little bit of skewing, right? It gets kind of steep here at the end. That's, in fact, it's steepest at the tails, isn't it? It's real steep there, it gets real steep here, and then it's kind of average in the middle. So is there a relationship? Yeah, definitely a relationship. So then the question is it frequency or is it severities? Do people with bad credit scores, do they have more accidents, or when they have an accident, it's just a lot worse? Do people with good credit scores? So what's the problem with severity? Can y'all see an issue with severity? Do you think there's a relationship between severity and credit scores? What would you assume people with good credit scores would be driving? More expensive cars or cheaper cars? Probably more expensive, right? So that should by itself mean severity is higher, you would think. And people with weak credit scores, you hope they're driving cheaper cars, but maybe they have a bad credit score because they're driving more expensive cars. I mean, I'm amazed. I was on the credit union board at USAA, and this lady sent the complaint to the board because we went and loaned, the president went and loaned her money. And her complaint was, I've never defaulted on a loan from your credit union. She had 2 loans that she defaulted on with another bank, but she had never defaulted with us. And she said, you should give us a loan for a brand new car when she hadn't paid off the loan on her existing car to another bank. And she didn't understand why we weren't going to loan her money. You know, it's like, my word, you live a really stressful life. Why can't you just stick with the car you have? And it's like, if we're going to loan her money, we should loan her money to pay off her existing loan and not buy a new car. It just made no sense. Why would someone in that kind of financial difficulty? I don't know. Maybe she had a really good reason for needing a brand new car, but it didn't make sense to me. But yeah, it's possible. The reason they have credit score problems is they're just so bad with money. They're buying expensive cars, possibly. I don't know. Homeowners is a weird. Homeowners is always weird in this, and that's because of the mold issue. The mold issue definitely caused some issues. But here's the loss ratio. So you see the loss ratio 3 times difference between the best, but here you see a huge skewing at the end. But they're going to tell us we can't trust these numbers as much because there are some other things going on here. All right, so they looked at frequency and severity. The data shows that credit score has a stronger relationship to frequency than severity. All right, so that's kind of important. That makes sense with my theory that people with good credit scores have more expensive houses and cars, such that they're going to have larger losses, more severity. And so that might offset the severity side. And so frequency would probably be easier to measure. That is, as credit scores improve, the frequency decreases. They have fewer accidents or claims. Severity may decrease as well, but not at the same rate. For some data sets, severity is nearly flat. So it's definitely frequency is what you're seeing more often. Here's the frequency on auto. Here's severity. I don't see a relationship there, but they said it's not as strong. It looks almost like a straight line to me, but do y'all see a relationship? The thing I could say there is people with no credit scores, you don't want to give them auto insurance because they're going to file really huge claims for some reason. Looks pretty flat, right? And this again is personal auto. The issue is not whether credit scores is related to claiming experience, but rather credit scoring provides additional information over traditional existing. So he's getting into the second study. Right. So there's the study, and then you have all the appendix. So what is the appendix doing? A lot of the appendix is on this issue of disproportionate impact. So you can kind of look at the titles and see on race, on income, age should be in here somewhere, and just chart after chart on age. But if I've stared at these charts and I just kind of gave up because they're very pretty. They look like charts that were made before we had really good printers. And so this is how we used to do things. It used to be, you can't imagine, it was so expensive to print something in color. My boss used to get in trouble because we'd print everything and we were like, you can't print. The guy who had the printer came over, why are y'all printing so much stuff? Because it was just cost a fortune. So you would do it things like this to try to cut down on the amount of ink you had to use. So homeowners, auto, all that kind of stuff. And then they have some other charts from the different groups, so you can kind of, but I would, unless you're just really curious, I would stop at the appendix page and not go any further. Hope y'all didn't like keep looking for highlighted sections after the appendix because it's not there. All right, so there's the first study. So is a relationship? Yes, it's strong. It's more related to frequency than severity. I don't even know if the word than, I would say much stronger on frequency than severity. I think the severity is pretty weak. Is there a disproportionate impact in the use of credit scores? Yes, it's worrisome, but not illegal. But we're going to go to the second study to really figure this question out. Is it a surrogate for something sinister? Because the second study is going to say, well, not entirely, but the second study is going to say, can we get rid of it entirely? And we also have to make sure that credit scores don't predict things that are illegal. Perfectly predict things that are illegal. All right. Any questions on the first study? You see the two questions there. So let's get into the final study. I like this study because they use some statistical terms that hopefully you're seeing in your stats class that you get a little comfortable with. Chi-square and those kind of things, right? Y'all had some of this stuff in your stats class. So you're going to see stuff R-squared they didn't use, but they do explain why they didn't use R-squared. All right, so here's a good summary of their entire analysis. For both personal auto and homeowners, credit scores were related to claims experience even after looking at all the other variables. This means credit scores provide insurers with additional predictive information. That's a pretty key phrase, isn't it? Additional predictive information, and even this word, distinct from the other variables. Really important concept there. I'm going to copy that. I don't know how much Montemayor wrote this versus his staff.
Sir,
Uh-huh.
you know how you're saying about credit scores, how they mean like they're a pretty good indicator on the person, the personality and all that. And my cousin always had bad credit. The guy, he kind of had to live where they would take him, you know, like, well, they go by income and all that.
Yeah.
Is it kind of a coincidence that those places that judge by that always in high crime areas?
Well, a big issue for auto, I don't know the relationship there, but there is something called redlining
Correct.
that has been a huge issue for homeowners and auto insurance. Several years ago, the insurance industry met with Jesse Jackson, and they had a heart-to-heart. It sounded like it was a really good meeting where both of them were kind of pushing back on the other. I don't know what agreement came out of that, but that was an issue. People in high crime areas can't get insurance, but they really need it because they're in a high crime area. And there tends to be, you know, certain minority groups may be in an area that they can't get insurance, you know, and so Jesse Jackson's saying, you know, you're dealing with people who really need the insurance, they can't afford it, and you're charging them so much, it's just not possible. So this has always been an issue for the insurance industry. Credit scores is essentially piling onto that and just adding more to it. But the insurance industry says, yeah, but someone in that neighborhood with a good credit score, we now have something to help them. So that's, you know, that's their argument. Insurance industry always brings up that availability argument. It doesn't help people with bad credit scores, but at least they're helping someone. But yeah, this is a touchy issue. So by using credit score, insurers can better classify and rate risk based on differences in claims experience. For personal auto liability, credit score was related to probability of filing a claim, that's frequency. However, the department found little or no statistical evidence that credit score was related to the severity. This is for personal auto liability, not property. So part A, only related to frequency. So people with bad credit scores are more likely to cause other people damage than people with good credit scores. That sounds like that's kind of the personal responsibility. For homeowners, credit score was related to, what is that? Frequency or severity? That's frequency. The department found some statistical evidence that credit score also related to the amount of the claim, but was unable to draw a definitive conclusion due to what? Mold claims and some hurricanes. So the Baldwins, right? The Baldwins probably had a good credit score, I would guess. They were a massive claim. For personal auto liability, credit score varies in importance depending on the model the insurers use, but was generally comparable importance to territory and driving record, you would think would be a pretty predictable thing. I would think people would, well, I'm gonna show you some clips from, if y'all haven't watched this. So in about 20 years, you're gonna have 16-year-old drivers in your household, right? And so go save this. I can't spell. Have y'all watched this movie? This TV show, Canada's Worst Driver? It is, none of y'all have ever seen this. No one. It is shocking. It is absolutely shocking. They need to do a US Worst Drivers because this is, maybe I like it because I'm in this class and I like, but it is absolutely shocking. I don't know if I can find the worst driver. I saw the one which she was, they said she's it. There's no one as bad as this person. And I agree with them. She was absolutely horrible. There was a young kid before her, I thought was, I had him as my worst, and then I saw her. I was like, there's no way I would get in. Like, her brother rode with her. I don't know why he got in the car with her, but she was supposed to have one of the people from the show with her, but he refused to get in the car with her. So she had to have her brother with her. That's how bad. But yeah, I mean, this is a program you should show young people. They should do this for driver's ed because it is just amazing. So driving record, the people in that program, they had multiple tickets, multiple accidents. That one lady, it was the worst, my word. She was, I mean, it's like an accident in a week. Constantly on her phone, constantly speeding. Everything was like the start of a race, Formula 500. She floored it every time she started. She'd be off the road because she's on her phone and said, "Oh, that's okay, I'm fine." She would cut people. It was just horrible, horrible driving. But her driving record reflected it. There's no way you can drive like that and not get the attention of the law. Only class which reflects age, gender, marital status was more valuable. For homeowners, credit score was one of several important variables, not as important, but because of all that noise, they couldn't come to a definitive answer. Both personal auto liability and homeowners, the difference in claims experience by credit score was, there's that word, substantial. It's important to ascertain whether the relationship provides significant additional information. So this is the multivariate analysis they're doing here. So here's a little bit of statistics. This I don't understand. I haven't had an actuary explain this to me. But they say the methods are categorized as being either statistical or actuarial. Had one actuarial science major say she thought what they meant there was actuarial means when you're using insurance jargon, you're using things specific to the insurance industry. That's actuarial. Statistical is just, but to me, everything actuaries do is statistical. So I don't know why it would be actuarial, but not statistical. So anyway, they make that distinction. They did put it in quotes, so maybe they're kind of making the same point. As the statistical methods involve construction of statistical models by fitting hypothetical probability distributions to the individual data elements. The actuarial methods calculated relative claim experience by rating variable directly from the data and were used to cross-check conclusions from the statistical. I'm still not real sure what they mean by that. All right, so here's the rating variables. And when you combine them all in all the different types of classes, it's a massive number. It's almost not quite one category for every Texan, but there's a lot of them. The department included several common variables and multivariate analysis. They were defined by the personal lines manuals previously promulgated by the states. So personal auto liability is territory. So it gets to your point, Kenny, you know, what part of the city you live in and drive in. The class, they even tell you down here, class reflects age, which is interesting because what else do you see in here? So I can't explain why age is in there twice, but class includes age, and then they do the age. Age, gender, marital status. what kind of limits you have. Do you have a multi-car discount? Driving record points. Driving record points reflect at-fault accidents and serious vehicle-related convictions. I don't know what they mean by serious. Most of y'all probably know, if you get a speeding ticket, you can take the defensive driving and get that off your record, but I don't know how much, if that's,
Like when you get, defensive driving, because I've gotten tickets before, I was required to do defensive driving, take a 4-hour class. I don't think that stays on your record forever, does it? I don't think.
well, if you take the defensive, it shouldn't affect your premiums, but,
Right.
yeah, I mean, it's, yeah, DWI would definitely be it. But I think, speeding tickets do affect your premiums, so that should be in here. May just not be in this list here. So yeah, DUI would definitely be a serious, at fault accidents. That's the other thing. What did I mean by at fault? So we're going to see, I'm going to show you some videos. I think most accidents, both drivers are at fault. I'm going to show you I'm going to hopefully convince you that the most dangerous thing you do every day is at a red light. And I think I'm going to show you some videos that's the most dangerous spot. And you're going to see some incredible crashes, people running red lights at 70 miles an hour. And the person, so you might say it's their fault for running a red light, but I think it's also the fault of the person at the red light not checking and looking around before they start out. So, so at fault, I think both drivers probably contributed to many of these. And I'm going to show you another big one that I see a lot. There's a bunch of cars in the left lane because everybody's turning left or going straight, and this guy's going right. And what is he doing? He's got an open lane. He's going 60 miles an hour. What happens when there's a bunch of cars in the left lane? There's a space, isn't there? And why is there a space? Let someone turn left. And what happens? You see it all the time. That guy's driving 60 miles an hour in the right lane. Someone lets a driver come in. They come in and whose fault is that? Well, it's that driver turning, right? They couldn't see, but is it really their fault? Or is it the guy driving 60 miles an hour? So when you see traffic stopped, you don't go 60, so there's certain things we do that I think both parties are at fault. One party ends up being the at fault driver. So I think at some point you have some person who's been in 6 accidents, but they're never at fault. I think you start thinking maybe there's some things they could do. On the homeowner side, obviously territory, protection class, kind of construction and those kind of things. Your deductible, your credit score. So those are the things they look at. All right, we'll finish this up from here. But you see we're going in next class. I'll show you the rubric so you can start thinking about it, but you probably don't care until we get closer to the exam anyway.